This is the Nichols-Patrick Current Federal Tax Developments for the week of February the 8th, 2016. Current Federal Tax Developments is brought to you by Nichols-Patrick CP Incorporated and your state Society of CPAs. I'm Ed Zollers, and I'll be talking to you about what's gone on this week in the area of federal taxes. And we've had a little bit more busy week because, hey, the government's back in session. We got a few people back there. The snowstorm finished up. And so we have a few more things happening this week on the governmental side. So we're going to start taking a look at what's happened this week, and probably one of the big things that came up initially and that a lot of us ended up being hit with was the fact that you may have been aware we had a nice little snowstorm in DC. So our snowstorm in DC caused all kinds of problems. So because of that, we're going to start out with that discussion, and not the snowstorm, but when the IRS came back, they had a little problem with their actual system. So you may have heard that the IRS e-file system was actually down, and that was what we're talking about there. So we're going to bring the system back. We're going to talk to you about what exactly happened. So let's go ahead. The IRS electronic filing system was down as of Wednesday. It came up late on Thursday, so you may have noticed that. We actually lost it probably late on Tuesday. Now the system itself was affected. It was affected electronic filing, where's my refunds, and applications for EINs and the like. Those were the big things affected. While a congressman was speculating on TV in the morning, which is always useful for a congressman to do, that it may have been a hack, in essence, his actual statement was, well, it seemed to him like a hack was very possible. Unfortunately, what that got run with by everybody was, oh, it was hacked. And after that, his office never gave additional comments. Nothing else came out. The IRS's statements, at least as of this point, I'm taping this on Friday morning afternoon time, actually, depending on what part of the country you're in. We don't have any more information with regard to that except for what the IRS has told us. Now, the systems were restored Thursday night. The IRS indicates we expect no major refund delays. The IRS statement was the issue was hardware related. Early reports suggested it related to electrical failures, although the IRS has not confirmed that now. They're back. They don't seem to have that as a statement. All the statement said was there was a hardware problem of some sort. In any event, all of the affected systems supposedly are back online. So for us, it was mainly an issue, and I think for a lot of us, because we have our filing handled via people like, CCH, Intuit, we talk about Thomson Reuters, who were basically holding those files. If we had anybody who had filed, probably many of us didn't see a major hitch, except for the fact that it took a little longer to get those back. And if you're like my practice, this time of year, we simply don't have that many people electronic filing anyway. So that's part of our issue here. So very, very few people are actually doing the electronic filing. So because of that, we don't really have a problem there. So kind of an interesting aside, but not really anything that was a major problem for us. Next up, let's talk about some things that were released. And this, we begin to now talk about our standard citations, Notice 2016-12. The IRS this week actually issued here the cents per miles and fleet average valuation rule limitations on vehicle costs for 2016. For the cents per mile method, use of that by a taxpayer, by an employer for valuing the employee's use of a car in certain limited situations, the maximum value is $15,900 for a passenger automobile, which is actually down slightly from 2015, or $17,700 for a truck or van. For those using the fleet average valuation rule, the limits this year are $21,200 for a passenger vehicle or $23,100 for a truck or van. That's kind of our background there. Nothing really fancy there. It's simply an update to the numbers. Nothing else has changed in that particular area. The next development, we're going to go to the cases now. And so we're going to start talking about a case here. This particular case is the estate of Stoller versus United States. And we'd actually talked about this case previously when it first came up. And there we dealt with it primarily with the hobby loss problem and the issue about whether there was just cause for late filing return. In this case, the estate appealed that. Now, this is actually a case of an income tax case, and one of the original parties there, the husband in this case, has died in the interim, so it leads now with his estate is the lead in the case. But they filed an appeal. And we're not going to go back over what we talked about last time, because basically they lost just as before. They were found to be subject to the hobby loss limits for the S corporation activity which they conducted, which related to Tennessee walking horses. They were breeding those horses. But the problem came up with this, and this is where things went a little bit more wrong for them. They rented property to the S Corporation. Now, since the S Corporation activity is being limited by the hobby loss rules, they were effectively getting no deduction for the rents paid, but they were having to pick that up on their personal return. The taxpayers said, well, to be fair, since you're effectively not allowing us a deduction on the S Corporation return, we shouldn't have to pick that amount up as income. Unfortunately, the Seventh Circuit said, you know what? Sorry, guys, that doesn't work. You decided to arrange your affairs in such a way that you had a S Corporation that leased property from you. The fact that that S Corporation, which is a separate entity, now we determine the activity in there is not being handled for a profit, that doesn't convert the fact that it paid you rental income, and you still have to recognize that. So the taxpayers were not allowed to take the rental income off the return. That means they effectively not only didn't get the losses from the horse operation, but they've effectively manufactured income on their returns. So it kind of goes from bad to worse, shall we say, with the relations of how this goes. Have a couple of things this week dealing with IRS notices related to qualified plans. First one's going to come up is we have the IRS in Notice 2016-16 has issued some guidance on permitted changes, mid-year changes for safe harbor 401k plans. For those of you not up on this, safe harbor 401k plans, if you adopt the plan and you make either a minimum matching contribution or a minimum across-the-board contribution, there is you do not have to limit the contributions of the highly compensated using the ADP ACP computations, the average contribution percentage or the actual deferral percentage testing. Neither one of those has to limit you if you make a safe harbor. For many very small plans, that actually is what's almost needed. The problem is, if you have only a couple of rank and file employees, action by one of them can have a disproportionate effect on what the highly compensated can defer. So in many cases, it may make more sense to use a safe harbor plan to skip the problems that you're going to have with the highly compensated is discovering they can't do anything with the plan because one of their two employees decided not to put anything in the plan this year. But the usual problem we have with these plans is generally a safe harbor plan is not allowed to change its status each year. So you basically can't change your structure each year. So if you're a safe harbor plan, you're not allowed to change basically how you're doing it. You're not allowed to change your method. You can't change plan terms during the year. In this particular case, we're going to have a case where we can allow them to make certain mid-year changes while retaining safe harbor status. The notice tells taxpayers or those who are adopting it what they have to do, including giving a new updated safe harbor notice, preferably, if at all practical within the time frames involved, 30 days basically, at least 30 days and not more than 90 days before the change. However, if the change is one, let's say like a retroactive increase in the matching percentage, then the entity is allowed to give the notice as of the date of change. There's also, must be given a reasonable opportunity before the effective date to change their cash and deferred election. That's also recovered. Now, this notice is important because it doesn't say you can do everything in there. It does not cover all changes. For instance, some changes must be made under the specific provisions found in the regulation. That includes adoption of a short year, any change to the plan year, adoption of a safe harbor status on or after the beginning of the plan year, or reduction or suspension of safe harbor contributions, or changes from safe harbor plan status to non-safe harbor status. All of those have to be governed by the regular regulations. As well, there are some that simply aren't permitted, period. And these are also listed in here. They'll tell you that you can't have the mid-year increase to increase the number of completed years of service required to them to have a non-forfeitable right, a mid-year change to reduce or narrow the group of employees eligible to receive safe harbor contribution, a mid-year change to the type of safe harbor plan from a traditional safe harbor plan to a QACA section 401k safe harbor plan, or a mid-year change to modify or add a formula to determine matching contributions if the change increases the amount, or to permit discretionary matching contributions. And there are some special rules that can allow you in those cases to make some changes. Again, if you're thinking of doing this, you have a safe harbor plan. We've already started 2016. You now determine that there's some changes that should be made. This will let you understand what changes can be made and what you have to do to make those changes work. Next up, we have proposed regulations come out this week, also in the plans, on closed defined benefit plans. We had previously discussed, this is Regulation 125761-14, issued on January 28th. It deals with closed safe harbor plans, or closed defined benefit plans, I should say, that were covered by Notice 2015-28. These are companies that have shut down their defined benefit plan. They basically let everybody who's already in it stay in the plan, but they are now covering everybody else under defined contribution plan. The problem with that is over time, as people retire or people leave, those defined benefit plans tend to end up with an excess number of highly compensated employees. In Notice 2015-28, they provided some special rules that allowed you to deal with this. If you've been dealing with those special rules, they're going to end this year. So this rule says how they're proposing to handle it with plans, and it also states that generally you can use these proposed regulations, you can rely upon them, even if you don't, so that you can go ahead and make your changes now. And if the regulations end up being more restrictive, they will not be applied except prospectively. It also deals with plans that attempt to provide a special benefit formula to a single employee. The IRS believes that was an abuse, so they added that on to this regulation. Again, if you have either of those cases, you want to probably take a look at these proposed regs. Again, Regulation 125761-14, that was issued on January the 28th. Next up, a minor change for your taxpayers and your clients who are not-for-profits and are a small exempt organization that's been filing the EPostcard. In the exempt organization update for February, the IRS noted that EPostcard filers will file a report via the IRS website for any filings after February the 29th of this year. Previously, they'd filed that via a site run by the Urban Institute. So it's going to be a different location. The big takeaway for this is that the organizations are going to need to complete a new registration regime in order to file on the IRS website. So you may want to warn your small not-for-profits that have been filing the EPostcard that the way they're going to file is changed this year, and they need to go ahead and be ready to take advantage or to work with that change. I should say, not to take advantage, they're going to work with it going forward. Next up, we have a Chief Counsel advice that deals with 1031 exchanges. This is Chief Counsel advice 2016-05-17, 2016-05-17, issued on January the 29th. In this case, the taxpayer had exchanged aircraft that was used for both business and personal uses for a new aircraft. The question that's arising on exam was, should that be covered by Section 1031? The taxpayer had claimed that the entire exchange was covered by 1031, recognized no gain on transferring the old airplane for a trade-in on a new airplane. The IRS agent is somewhat concerned about this. Well, the national office said there are really two issues to look at here. We need to look at both of them. First thing is, how do we handle a split asset? How do we handle an asset where there's both personal and business use? Generally, under Section 1031, you can only Section 1031 exchange an asset if it is used for productive use in a trade or business, or it is for investment purposes. Generally, personal use assets are not eligible for 1031 exchange because they don't meet one of these two requirements. But let's think about the real world problem of if you have a car or you have an airplane, we have this asset that's partially personal use, partially business use. The analysis concludes that, in fact, there's no justification under 1031A to split that into two assets, because that would obviously be one solution. We could have the personal asset, let's say the 40% personal use part of the asset, that would be not eligible for 1031, and the 60% business would be. But the IRS National Office concludes there's no support whatsoever for that in the code. In fact, they point out that the IRS Revenue Ruling 2008-16 that was issued on vacation homes, that safe harbor rule from a number of years back, you may remember, that whole revenue procedure doesn't make sense if it really should have been two separate assets, that there would have been no need for the procedure. So the National Office says no, it is 100%. Either an asset is deemed to be held principally for use in a trade or business or for investment purposes, or it's not. And the mere fact there's some personal use doesn't mean it's not being held for productive use in a trade or business. However, that personal use does lead to the question whether the taxpayer's principal intent was to have an asset to be used for productive use in trade or business or not. It then goes on and says, now we got to determine with this aircraft in front of us, how do we determine if it's being used for productive use in trade or business? And first piece of bad news for those of you that like things that are, safe, that have safe harbors or like to have clear, bright line tests, it tells us there is no such test in the code. But then, interestingly enough, in the following paragraph, it goes on to kind of tell the agent here in this situation that because of the high personal use, they think it's highly likely it's not going to qualify. They suggest that you consider measurement of business investment use versus personal use based on flight hours, not just flights. The percentage of business investment use versus personal for flights and flight hours determined before the exchange, and which flights and flight hours are determining to be repositioning flights and the nature of flights following the repositioning flights where we move the plane around. And it finally concludes that if they determine more than 50% of the use was personal, that the national office feels justified in claiming that they could take the position that this no longer qualified as a business use, this no longer qualified as an asset held for productive use in the taxpayer's trade or business. Interesting, after telling us there is no way of testing, there is no safe harbor, they gave us something that a whole lot of people, a whole lot of agents would use as a safe harbor test. So it'd be interesting to move forward from there, but be aware of that. Next up, we have an issue on an S corporation. This is Private Letter Ruling 2016-05-002, issued on January 29. In this case, remember, S corporations can only have one class of stock outstanding under Section 1361. If they ever get a second class, they're no longer S's. One class of stock is the same rights to distributions on an ordinary ongoing basis and rights to distribution and liquidation. In this case, the Articles of Incorporation provided shareholders could agree on how to distribute liquidation proceeds and could make it different for different classes of stock they had issued. Now, these classes of stock otherwise had the same rights and obligations, but they could agree to do it differently. And in fact, they had entered into such an agreement. Entering into that agreement meant they had two classes of stock outstanding. This was noticed. Good news is we can fix it. What the taxpayers did was undid everything. So they unwound all the agreements and reversed their actions. The IRS ruled the violations were inadvertent. That's also good news. But the bad news was that the IRS, that you had to apply for a private letter ruling request to do this if a taxpayer fouls this up. The fact, if your taxpayer is exactly this fact situation, you can't rely on this ruling or state that, hey, well, we don't need a ruling. You absolutely need a ruling because you must get the IRS's waiver. And that, unfortunately, as you'll discover, you look up the cost, is not cheap from both the user fee side and just the time involved in getting it done. Finally, for those of you who've been waiting for it, Form 8971 and its instructions have been released this past week in the first week of February. So if you're waiting for that because you filed a 706 after July of 2015, now you've got the form to do it. This is the form you use to file basis information for estates filed after July of 2015. That was added by Congress this summer. There'll be a Schedule A prepared as part of this. You'll see that's part of the form. It lists what each beneficiary received. It tells whether or not that asset, whether or not this item increased the estate tax or not, or would have had an impact on increasing the estate tax. If the answer is no, conformity is not required. If the answer is yes, conformity is, and the basis number. The due date for this form is the later of February 29th of 2016, because remember, this particular form, we had a delay. Congress said it's due 30 days after the 706 was filed or when it is due. The IRS gave us a delay earlier in the year to say that nothing be required for February 29th. Now that they've released the form, not quite 30 days, just a little bit less than 30 days before it's due, essentially everybody needs to assume that you must get these forms in on time. Failure to do so triggers all those nasty penalties now for late filing information returns, which you do not want to pay. So you probably want to make sure that you get all of these filed on a timely basis and you get everything taken care of. So if you have not looked at this form, I strongly suggest you look at it. If you've not started accumulating information, you're going to need to file this form. I really suggest you start looking at that right now. This has been the current federal tax developments for the week of February the 8th, 2016. Current Federal Tax Developments are brought to you by Nicholas Patrick CP Incorporated and your state society of CPAs. Be sure to go to our website at currentfederaltaxdevelopments.com for links to the materials this week, as well as go there to find information regarding updates during the week, as we'll post updates for items as they occur during the week on that website. And be sure to join us next week when we'll go through additional information related to federal tax developments. And so until next week, go ahead, have a good week, get into tax season, and we'll see you next week.